Good morning. So breaking news today, we have Trump testing positive for COVID-19. I'm sure he's not sure whether to believe what's happening because he doesn't seem to believe in COVID. So it has markets in a flurry, equities are down, currencies are weaker. Volatility is the one thing that we know will continue, and it is continuing. But it is great for our portfolios. We do use the volatility, we harness the volatility, and it just gives us opportunities to get good entry points and good exit points for our portfolios. So we'll talk about that today. Also lots of other things to talk about. COVID-19 in general, the markets had a tough month in September as a result. Brexit is back. More bad news from South Africa. Contested US elections, if Trump's even well enough to have participate in the election. And looking out towards Japan, we've got Suganomics replacing Abenomics. So quite a few exciting things to talk about. But before we get there, we're going to just have a quick squiz at the surveys again, just to show that the Sygnia portfolios continue to perform well in the low growth, high volatility environment. You can see there over 1, 3, 5, 7, and 10 years, so pretty much every time frame from the low risk, low, medium, high, all the way to high risk portfolios, number one in the category. Similarly, diving into the high equity component, you can see they're doing nicely compared to the peers, up first across the various categories with a significant lead of over 10% compared to the laggards over a 1-year period. Over 10 years, performance is closer, but we are comfortable that the funds are doing well for the current environment. Similarly, looking against single managers, second over 1 year, second over 3 years, and longer term performance, which is the most stable and most important and representative of skill, number one, looking very nice there across 7 and 10-year time horizons. So performance looking stable. Our funds are well positioned for the low return, high volatility environment. So let's jump into markets. As usual today, and over the last 6-7 months, it's all about the global pandemic. And this is a picture of Anthony Stephen Fauci, looking tired, resigned. He spent the last year fighting Trump, trying to get Trump to believe that COVID-19 is important. Trump has fought back, so I'm sure Fauci's having a little bit of schadenfreude this morning, thinking that maybe people start to believe him in the US in terms of the COVID-19. But in general, it keeps everyone very confused. There's very little consensus on exactly what is happening, how the virus works. It seems to be related to blood groups, which isn't normal for a coronavirus. We're still debating whether it's seasonal, which most coronaviruses are. There seems to be no correlation to a person having or being positive relative to whether their spouse is positive. So if your partner is positive, there's absolutely no dependency on whether that makes you positive or not, which doesn't really make sense, because how are people catching it if you're not catching it from your partner? And the way it's spreading is also very clumped and very unusual. So bottom line is there's a lot of uncertainty. And with uncertainty, it leads to fear, and that leads to markets falling. And that we saw in September. Markets fell 8% from their peak in September, when the virus surged in Europe, particularly UK, France, and Spain. and some small measures of lockdowns were implemented, and fear came back, and markets collapsed. So the top right chart here shows you just what the various asset classes did. So the biggest fall was in the tech sector, which fell nearly 15%. You can see the NASDAQ here in blue. Gold fell 6% from its peak, along with equity markets, which were slightly better than gold. And our defensive satellites that we are invested in at the moment, the Fourth Industrial Revolution Fund and the Health Innovation Portfolio, both flat on the month. So very comfortable that our defensive positions are doing better than gold, and even equities are doing better than gold. So we remain confident that in these unusual low growth, high volatility environments, you can't rely on the traditional asset classes that are there to protect. And gold has its place, but it's certainly not providing capital protection, or didn't in September, it didn't in March. And we're very comfortable that the way we positioned our portfolios for Japanification is having success. September just showed that again. But in general, are we worried about COVID-19? Are we worried about lockdowns coming through in a global fashion and an extreme fashion? And the answer has to be no. And the reason for that is this chart at the bottom here. So the green line shows new daily cases. This is for the UK, but Spain is the same, and France. So what we're seeing is a second wave of cases coming through that eclipses the first wave. That on itself is quite terrifying. If you look at the number of new cases, far worse than the first wave we had in March. But it's very, very different this time. If you look at the light blue line here, that shows the hospital occupancy rate. And the dark blue line shows the number of deaths. So you can see the deaths have peaked in March, April, and the huge use of hospitals at the same time compared to fast forward to the end of September, deaths haven't ticked up at all. And there's been a slight increase in the use of hospitals. So the whole point of lockdowns was to try and alleviate the burden on the healthcare system by spreading out that demand on hospital usage. If you're not seeing the demand on hospital usage, you don't need to lock down in any stringent manner. Yes, it's definitely, social distancing is important. Not saying it's not, but minimal social distancing can achieve what we're seeing here. And it looks like, again, people don't really, there've been a lot of papers that have been put out, a lot of different theories. The spread of COVID-19 is not really understood. What the limited consensus there is seems to be that it spreads in a clumped fashion, but mostly in indoors, poorly ventilated areas where people have to shout or sing. So when you basically are forced to talk very loudly, I presume that you are projecting, and air particles are flying, and you're in a poorly ventilated area. So you're looking at pubs, nightclubs, churches, where they're singing. Those sort of environments tend to be the ones that are causing the problems. So certainly limiting capacity there is useful. But that doesn't mean the entire economy has to be locked down. So while we don't really understand these numbers purely, there are some reasons that the numbers are low. The one is that social distancing is certainly helping. So by limiting the amount of concerts and weddings and parties, limiting on people that go into restaurants and wearing masks, some level of social distancing is certainly helping avoid the spread being as fast. But at the same time, what we're likely seeing, why the case numbers are going up and why the hospital numbers aren't going up, is that healthy people are being tested. So in the first round here in March, people were falling ill, they were then going to hospital, they were being tested, and they were likely in hospital because they were positive. Now we've got 6 months later, a lot of people have delayed a number of checkups or surgeries that are required. So healthy people with stomach issues or heart issues or twisted ankles, whatever it may be, are being forced to test before they can go into hospital. Those tests are showing them as positive, even though they're asymptomatic, and that's then driving up this number, while at the same time not driving up the hospital usage or the deaths. The other reason is that there is a small amount of herd immunity that's coming through. Again, it's not massive, but it is helping the story somewhat. So despite markets falling 8% this month in September, as a result of the lockdowns, which we're seeing increase in Spain, in the UK, in France, we certainly don't think that it's going to lead to an economic disruption. So we're still positive on markets as a whole. Yes, you need to be careful exactly where you're investing, but we don't think that this 8% drawdown, which is the biggest drawdown since March, is going to result in further or become a more widespread concern. That said, there is still going to be volatility, especially when Trump's involved. But other positive reasons why news should improve towards the end of the year is, again, vaccines. We're getting closer and closer to a vaccine development. Pfizer have hinted that by the end of the year, they should have the vaccine ready. FDA confirms a similar date that towards the end of November or early December, there should be a vaccine ready. Now we're talking 6 weeks from today. And the economy is doing pretty well. So OECD has upgraded the world economic growth from -6% to -4.5%. Still not great numbers, I agree, but it's an improvement, it's a step in the right direction, and it's acknowledging that the economies are bouncing back far faster than we thought, that the pent-up demand that happened during the lockdown is being unleashed, and people are spending what they couldn't spend, and that the economy is rapidly coming back to a new normal, not the old normal, but rapidly coming back to some sort of normal. As a result, growth is being upgraded. So getting close to a vaccine, PMIs and growth is looking positive, and hospital usage is still low. So those three reasons make us positive that this dip is not going to translate into anything larger, and it's more just volatility that we expect to see in uncertain times. Trump. You have to laugh. So Trump has said that universal mail-in voting is going to be catastrophic. He went on to say that it is the most inaccurate, that mail-in voting could result in the most inaccurate and fraudulent election in history. So volatility, Trump, it's every day there's something he says or something that he tweets that results in markets moving. And today it's him testing positive. A few weeks ago, it was him trying to contest the November elections. So if you look at the top right-hand chart here, you can see the general election polls and the odds of Trump being re-elected. The red line is Biden, the top here. The gold line is Trump, that's this year. Otherwise, you look at the 2016 levels, which show Clinton versus Trump. So Biden is doing better than Clinton was in 2016. But at the same time, over the last month, Trump did narrow the gap towards Biden. And we really are starting to think that it's a neck-and-neck race, that it could go either way. So there was a lot of focus on first presidential debate that happened on the 29th. It turned out to be not as presidential as we hoped. In fact, it was just described as chaotic. And rumor has it that Canada is now considering building a wall between themselves and the States. Just chaos. And it's what we expect from Trump. There's a lot of noise. There's a lot of volatility. And he seems to be very focused on If he doesn't win, he's going to contest the elections. And that's going to result in a delay, and that is not a good outcome. So we've been watching the elections for some time now. If Biden wins, it should be good for the rest of the world because he'll have a more pragmatic sorry, I believe that this chart is not showing. There we go. Let me recap quickly. So top chart on the right here, Biden in red, 2020. That's the polls for the general election on the 3rd of March. That's compared to Trump this year in gold. And then if you look at 2016, blue is Clinton, who was ahead, as we know, of Trump in 2016, but still lost. So 2016 showed that polls aren't necessarily correct, that even though Clinton was ahead, she lost. Even though Biden is ahead, it doesn't mean that he's going to win. Yes, he seems to be more ahead than than Clinton was in 2016. And even though the gap has narrowed over the last month, the outcome of the presidential debate, the first debate anyway, appears to be that although both parties lost, that if there was a winner, it has to be Biden slightly. So, but it's still pretty much neck and neck. As I was saying, if Biden wins, generally good for markets. We're expecting a much better global trade policy if Biden wins compared to Trump's, which is far more chaotic and one-sided. So we're expecting a stronger global growth, particularly rest of world growth, if Biden comes through, whereas Trump comes through, it could be weaker. On the other side, we could see a lot more negative focus on the tech companies if the Democrats win, if Biden comes through, versus if Trump comes through, there won't be as much focus. So tech could suffer a bit more in a Biden presidency compared to a Trump presidency. So we've been watching those odds pretty closely because it will determine rest of world's growth in markets, will determine tech growth in markets. But the worst outcome would be a contested elections. The last time we had contested elections was in 2000 between Bush and Gore, when Gore contested the elections and the result was delayed for 6 weeks. Over that 6-week period, the US markets fell 7%. So we could see further volatility, even as we get closer and closer to a vaccine. The volatility that could come through from this US elections might result in markets falling again. So right now we're concerned about contested elections. That is the most negative of the three outcomes. Biden's the best, then Trump, and the worst would be a contested election. Trump obviously is trying to do whatever he can to win. So we are expecting a lot more volatility. His attempt to ban WeChat and TikTok on national security concerns was halted by a federal judge, and it is one of the reasons why tech did fall more than 10% in September is the Cold War between US and China. Generally, we are very positive on tech. It is one of our satellites. We think that there's a structural theme of moving away from brick and mortar spend to online spend. But in the short term, there are some catalysts that could be negative. The US-China Cold War, tech Cold War is one of them. A vaccine breakthrough, which could lead to slight normalization of online spend versus brick and mortar spend. Valuations, and this is particularly for the big 6 tech stocks, not so much for the small caps, but for the big tech stocks is quite scary. 9 times revenue. It wasn't that long ago that people would pay 9 times earnings. Now we're paying 9 times revenue. It's very scary. The bottom right-hand chart here shows the tax rates of the big 4 tech stocks. You can see here, Apple at 17%, Google at 16%, Amazon at 13%, Facebook at 4%. And those have to be a concern as well. And compared to traditional companies which are paying over 30 up to 40% tax rates, we could see some pressure come through to have higher tax rates paid by the tech companies. Also a headwind to their earnings if that doesn't happen. If anything else, it's going to lead to increased scrutiny from an antitrust perspective and a privacy perspective. When they're making super profits, someone will attack those profits. So we are concerned that there could be some short-term headwinds in the sector. That's why we sold out of our FANG stocks quite a while ago and invested that into our healthcare portfolio and our fourth industrial revolution portfolio, which are less stretched from a valuation perspective and less at risk from antitrust and privacy issues and tax issues than the big tech stocks. But bottom line is, while we're seeing the tail end of volatility from vaccine, we're probably seeing heightened volatility from US elections until the 3rd of November. It's only a month, but that could be extended to another month if the elections are contested. And with Trump now testing positive and going into quarantine, it just leads to a whole nother layer of uncertainty. And uncertainty is what markets hate. They almost don't mind bad news. They love good news, but they certainly hate uncertainty. So it's nice to see Boris back in the limelight. He certainly, like Trump, provides a lot of interesting news. And he's now saying that the Brexit deal never made sense. And he's threatening to breach international law to override it. This is from the guy who started the Brexit referendum, advertised on buses, convinced the UK population to vote for Brexit. He then negotiated the treaty. He got the treaty over the line. He signed a withdrawal agreement. And now he's saying it never made sense. Politicians really, they're driving markets more and more. They're leading to more and more volatility. They're flip-flopping like you cannot believe. It's really, we live in very, very strange times. Quantitative easing, low growth means that any economic volatility is a concern and leads to market volatility. And any politician's statement now drives potential economic volatility and is driving market movement. So we have to keep a very close eye on what's happening with our politicians. Trump in particular, Boris now that he's back. So as a result of Boris Johnson threatening to breach international law to override the withdrawal agreement with his new internal market bill, the pound saw its weakest level over the last 6 months, as shown in this top right-hand chart. The EU obviously has threatened legal action. They think it's not right that is happening, and there's now less certainty that we are going to see a deal done this year. As I've said many times in the past, it took Canada and the EU 8 years to get a trade deal signed. So 1 year was, even in normal times, would have been very, very, very difficult for the UK. We're looking at the 15th of October as the date when an agreement needs to happen between the UK and the EU to allow time for it to be ratified by the year end. Very low probability that's going to happen. So we are expecting some more noise. Most likely scenario is there will be an extension, and that'll just play on with more volatility happening into next year. Poor old Johnson, though, at the same time that he's trying to negotiate Brexit and flip-flopping on his withdrawal agreement, he's seeing increased backlash at the way he's handling COVID-19. I think all politicians are, certainly. Trump's being attacked by his handling of the virus locally. Our government is being attacked for the way they're handling. No one likes lockdowns. No one understands the virus, and that's the biggest problem. Is when you don't, there's no agreement. There's a lot of scientific data, but a lot of it conflicts. You know, should children go back to school? Shouldn't they? Should the economies go back? Shouldn't they? It leads to a lot of discontent, and in particular, when growth is slow, when people are losing their jobs, when the pie is shrinking, that just leads to more and more discontent. When you're in a bull market, politicians can kind of get away with anything because no one really cares. Everyone's enjoying some level of prosperity. So it's a difficult time. And the bottom chart here shows that Johnson's actually not even leading the polls. So there's a lot of discontent with what he's doing. And in fact, there are some Tory members of parliament that are threatening to rewrite legislation so that ministers can't impose pandemic rules without first putting them to lawmakers for approval. Personally, I think that's a great idea. Yes, it does. It does impact what your emergency powers are. But at some point, we have to acknowledge that the coronavirus is a new normal. It's no longer an emergency. I mean, locally, we keep extending the state of emergency each month. But when do we say, hold on, this is not an emergency anymore. This is the new normal. The coronavirus is going to be with us for another year. We are learning to deal with it. We've got ways of dealing with it. It's not an emergency. Government hand back those emergency powers. Let's get some sense and let's get some agreement on what the best way is to manage the economy. Certainly, that means Trump is seeing that backlash. Johnson is seeing that backlash. Locally, there is a backlash, and we need to move past the state of emergency to the new normal. Until then, a lot more volatility every which way. So looking east towards Japan, again, it's been a while since we've had Japan in our economic updates. They tend to be very quiet and try to get things done. But there was some big news. We had Yoshida Suga elected as Prime Minister of Japan in September, succeeding Shinzo Abe. And that was some concern when Abe announced his resignation. It leads to a little bit of volatility early on in the month. But we've had Suga being elected, and fortunately, he's been very vocal about his continuity cabinet. So he's saying what's worked in the past is working, and he's going to stick to it. So Abe was very focused, and he became quite famous for his 3 arrows approach. So that was monetary policy, fiscal policy, and structural reforms to drive economic growth. And we've used Japan as the roadmap for a low growth, high volatility environment for some time now. They started QE in 1997. Abe came in 2012, so Abe's been there for 8 years. He's been trying to get some sort of growth back on track. And while Japan as a whole, and I've shown this before many times, hasn't done that well with their QE over the last 23 years, if you look back at Abenomics over the last 8 years, that's actually been relatively successful. So look at the stock market over that period, the white line doing quite nicely, economic growth flat, but better than the previous 2 decades, and bond yields leading to some sort of wealth creation if you are long bonds. So some success from Abenomics, and Suga confirming that he will continue with that. So the one arrow that Abe did struggle with was structural reforms. So he was criticized. He did everything he could on monetary policy. He did everything he could in fiscal policy, but he was criticized for not doing enough on reforms. And that is the hardest thing to do. It's relatively easy for central banks to lower interest rates, and there's only a couple of people who have to agree to it. It's a little bit more difficult for fiscal policy. You have to get cabinets to approve it. But reforms around the world are difficult. We're struggling with it in South Africa. Japan's struggling with it. There are hard decisions that generally involve cutting costs, job losses, or at least job restructuring, and people don't really like them, even though they are necessary. So one of the things that Suga has promised to push hard and to accelerate is reforms, and that continuity in the three arrows approach has led to some stability. Japan has recovered, equity markets have recovered over the back end of September. Their currency recovered towards the back end of September, and we are seeing some positive light coming through there. So central banks and governments to the rescue, at least in Japan. In the US, we had Powell also give some positive news. He's sticking with his average inflation targeting. You can see here, bottom right chart, they're now targeting average inflation of 2%, the dotted line, and PCE annual inflation rate at 0.75, way below 2%. So there's a lot of room. And he said that interest rates will stay flat for at least the next 3 years. Very, very positive. Positive for the US, but more importantly, positive for the rest of the world, because the emerging markets in particular, 80% of their foreign currency debt is in dollars, weak dollar, low dollar interest rates, very positive for liquidity in the rest of the world, very positive for growth in the rest of the world. So again, the US being very beneficial to global liquidity, and Japan being very beneficial to global growth, and central banks and governments continue to be positive to markets and not negative. So we're very happy to see that. Looking locally, Tito. Tito seems to have a good sense of humor, and I think he needs it. He's got a tough road ahead of him. We've got the October medium-term budget policy statement happening on the 28th of October. Very, very big milestone in South Africa. Very tough job for Tito. At his last meeting, he said, "Wide is the gate and broad is the road that leads to destruction, and many enter through it. But small is the gate and narrow the road that leads to life, and only a few find it." He knows it's going to be tough to do what he needs to do. He needs to get reforms, and as I've mentioned, getting reforms is not easy. The South African government came out with a three-pronged approach to COVID-19. First was monetary policy, second was fiscal policy, and the third was reforms. We've had the first two. First was very quick. We had all sorts of support in terms of interest rates being cut. The second was the 500 billion rand program. We've been waiting for structural reforms for quite some time now, and we desperately need it. So our second quarter GDP came out, was horrendous. Our GDP fell 51% quarter on quarter, taking South Africa into the longest recession since 1992. We've now contracted 7 out of the last 10 quarters. Top chart there shows the quarterly GDP growth in South Africa. You can see 3 green bars, the red bars, 7 out of 10 contractions. That's an all-time record. I mean, that is horrific, absolutely horrific. The OECD has cut our growth forecast to minus 11.5%, and a number of global institutions are now predicting South Africa is on the path to become a failed state. It's very, very concerning. And our markets are reflecting it. Foreign holdings of South African bonds have fallen below 30% for the first time since 2012 when we entered the WIGBY. We got up to a high of 47%, now down to below 30%. South Africa domestic-focused equities have fallen 50% to South Africa listed globally focused equities since the beginning of the year. So foreigners are voting with their feet. They're selling our equities, they're selling our bonds, they're selling our currency. We've got Bloomberg and we've got Euromix saying that South Africa is going to become on the path to become a failed state, and they're leaving. And looking at our growth numbers, it's understandable. But also looking at other factors, and debt consolidation is vital. We've got to a point where our debt service costs this year will be 22% of our GDP, up from 9% in 2009. That's 1 out of 5 rand is going to interest costs. If our debt accelerates any further, we are going to be in a position where we cannot actually escape from it. And debt consolidation requires reforms, and we're not seeing anything. We've still got governments in an ongoing legal battle with trade unions over wage negotiations. We're now in our 13th year of load shedding. 13 years, and we still haven't got that right. SAA requires 10 billion rand just to sustain its business rescue program. We're not even talking about fixing the problem, we're just talking about delaying the inevitable. So when you're looking at those problems, when you're looking at the level of debt, you can understand why the global institutions are feeling this way. So structural reforms are essential. Unfortunately, the bottom right-hand chart shows, this is from IOR, shows where government and ANC policy are at the moment when it comes to reforms. So positive reforms on the right-hand side, unfortunately only one, that's SARS. We've got modest reforms coming through for telecoms, mining, tourism. However, if you look at where reforms are going backwards, that's a far longer list. We've got property rights, labor, empowerment, austerity, pensions and savings, healthcare, SREs, electoral system, and welfare. So if anything at the moment, reform is going backwards, not forwards. And it again shows the urgent need that reforms happen going forward. And it puts a lot of pressure on Tito. So he's got his medium-term budget policy statement on the 28th of October. And what's he going to do? He can't make too much of a good story because he needs to keep pressure on the fact that reforms have to happen. And it's going to be very hard for him to actually have a good story. On the one hand, expenses need to be cut, but there's still ongoing legal battles about wage negotiations with labor. So will that happen? There's a chance he might assume that they are going to happen, so expenses might not get worse, they might not get better. On the revenue side, they've assumed up to now 10.5% GDP fall. So far, we're not there yet. So far, the running GDP falls 7%, so that could lead to an improvement. But if we end up with the OECD number of minus 11.5, it could be worse. So we'll have to see whether it's going to be a positive or negative catalyst. And that is a concern because we already have reached a point of crowding out. And this is the biggest problem right now. Well, it's the biggest opportunity from an investment perspective, depending on where you are, but it's also the biggest concern. So the lack of reforms, the lack of growth has led to, the COVID-19 has led to huge issuance of bonds. That huge supply has forced the yield curve to the steepest it's ever been, which is an opportunity for investors, and I've got a slide on that later on. But at the same time, what it's leading to is it's leading to crowding out of the market. When investors can get inflation +6 risk-free from government-guaranteed bonds, why would they bother about investing in anything else? Why would you buy equities? You can get 10% in bonds. Why would you worry about infrastructure or credit or anything else? So we are seeing that this huge amount of debt that's coming online because of the huge budget deficits we're running, crowding out private investment in equities and bonds, and leading to equity markets fall, making any projects that you want to start very difficult because it's so expensive to raise money. So government needs to urgently address that. But unless there's investment confidence as a result of reforms, we're not going to see the yield curve come down. Crowding out's not going to happen. Fortunately, the government's very aware of that. And when they came to discussing the infrastructure projects, crowding out was something they mentioned, that they spoke about finding ways to crowd back private investment. So they are aware of it, and we should hopefully see some positive news. And certainly, the infrastructure program that pension funds will have to fund is a definite positive to growth. When you think about how well our economy did in 2010, which is the last big infrastructure boom, things were really, really good then. Yes, there's some global headwinds at the moment, but if we can get some spend happening, infrastructure spend, it's good for job creation, it's good for the economy. If it's productive spending, which it is, it's in fixed asset investment, it's good for future growth, it pays for itself, it's a positive story. So how do we put this all together? UK, US, Japan, South Africa, volatility. It's a pretty tough global environment. So we need to look structurally in the long term and then tactically in the short term, as we always do. So I've mentioned this slide before, how we think about the markets. We don't have any gold in our portfolios. We don't have any double bonds in our portfolios. We do believe that those are asset classes that are distorted from quantitative easing and aren't providing the capital protection they used to. So we have our 5 satellites, our 5 alternate growth satellites, which we think are better positioned to weather the long-term storm, and to some extent provide capital protection in the short term. Not always, but to some extent. So we have our core portfolio, low cost, very important to have a low cost, diversified core of local and global equities, of local bonds and cash. Then we have our satellites. Our first one is specialist global real estate. So the 4 green satellites are global. We only have one local satellite, that's the credit infrastructure. Global property is an asset class. We have the SIGP ETF. We've recently gone from holding very little of that to being very overweight that asset class. We think that the portfolio is defensive and well positioned against COVID-19. We are going to be hosting a special webinar on that in the next 2 weeks, so please keep your eyes and peeled for that. Our SIGP global property ETF doesn't have any hotels. There's no exposure to resorts or leisure, and a very small exposure to retail. So it is well positioned to weather the storm. It's in defensive specialist sectors, including cell phone towers, hospitals, things that will do well regardless of COVID-19. It has underperformed the MSCI World by 30% over the last 18 months or so, and we think it offers value now, and that's why we've gone from holding almost nothing to holding quite a big stake in that. Our second satellite is technology. As I've mentioned before, we sold out of our FANG portfolio. We were holding our 4th Industrial Revolution portfolio, which is over the month of September was positive, flat to positive, so it's working well. Here we expect growth from market share gains. So even in a slowing growth environment where GDP is not doing that well, you get market share gains to help those companies perform well. Our third satellite is emerging markets. This is a longer term story, that we are seeing some support in the short term from China, which is surviving COVID-19 far better than the rest of the world. And longer term, we expect Asia in particular, with the emerging middle class, to see strong growth in consumer spend compared to the rest of the world, which are experiencing aging demographics and slowing working population growth. Fourth one is healthcare, and that's short term doing very well because of the vaccine development, and as you saw in September was again flat to positive. Longer term, we think there's structural tailwinds to this because of aging populations and increasing healthcare spend. The last one is credit infrastructure. That is our local satellite. It is part of our move to diversify from equities locally into a more stable and uncorrelated asset class. It does particularly well in low growth environments where companies aren't thriving, but because of very low interest rates, companies aren't going bankrupt. So you get a decent yield pickup because there is risk because of low growth, but you're much more secure because there is a very low chance of them going under. So it's a good way to diversify, and we have had that. It's also a good platform for the government's infrastructure program. So when that comes online, we will use this satellite as the appropriate vehicle to harness that exposure. Overall, we have 2 overlays. The first is our tactical asset allocation overlay, which is our short-term harnessing of volatility to protect capital and add value. And then we've got an ESG overlay, which encompasses all our portfolios, both core and satellite, passive and active, where we ensure that ESG is built into our philosophy and our investment processes, and to ensure better returns and a better environment for the future and for now. So that's our overall view for our portfolios from a structural perspective. From a short-term perspective, I'm actually going to only talk about this chart, because I think it's the most important chart to discuss. So we continue with our underweight SA equities because of low growth. We continue not holding any SA equities, SA property because of low growth. We'll probably only start to look at SA property when we go overweight SA equities. We overweight global equities because they are better diversified and have high exposure to tech and healthcare, and can handle the COVID recession better than our South African equities. But our biggest position at the moment is overweight South African bonds relative to South African cash and South African income. Now, I've spoken about this for a while, I think over the last 6 months. It continues to be that position. I think it's quite a unique opportunity, and I think it won't last forever, because once reforms come in, once growth starts to stabilize, bond issuance will come down. So already the government is over issuing. So despite the huge amounts of bonds that have to be issued, for some reason, I'm not quite sure why, Treasury is, by the time we get to the medium-term budget policy statement in a month, will have over-issued 100 billion rands worth of bonds. That in itself is more supply, so the yield curve is steepening. So either if there's positive news from the medium-term budget policy statement, or even if there's neutral news, but Treasury acknowledge that they've overissued 100 billion and they can start to slow down on that issuance, or if it's acknowledgement of the crowding out story and that they pull back on the issuance of local bonds, whatever it may be, we're likely to see some sort of flattening of the yield curve. Okay, but I'm getting ahead of myself. Looking back to a year ago, this chart shows the annual income yield on the y-axis and the risks on the x-axis. So if you look at the red line, a year ago we had very high real yields. So you put money in the bank, inflation was at 5% and cash was giving you 7%. 2% real yield, fantastic. Almost no risk. I mean, this is pretty much risk-free from a RAND perspective. You have money in the bank, can't lose capital, you're earning 7%, inflation plus 2, it's pretty juicy. You go all the way out to the far end of the yield curve, to bonds. You're taking on credit risk, taking on interest rate risk, you're taking on duration risk. You probably only, a year ago, you're earning an extra 1%. So all of that additional risk, and you're only getting extra 1% return. So at that point, it made a lot of sense to sit in our enhanced income fund. There you're earning 9%. You had, your only risk was credit risk, or liquidity risk. You weren't exposed to bond risk, which is interest rate risk. You weren't exposed to duration risk, and you got this decent return. Fast forward to where we are now. This is the yield curve post COVID-19. You've got interest rates that have been cut 3.5%. So cash is giving you 4.5%, maybe 5%. Bonds, on the other hand, our enhanced bond fund, which is sitting towards the end, is giving you 10%. So you're getting an additional 5-6% return by taking on credit risk and bond risk. So that does have some impact on your capital volatility. You will get your money back. That's the nice thing about bonds, is that, you know, if you invest in a bond in 10 years or 20 years, or that bond may be, you'll get your capital back. So if you have a long-term time horizon, that risk goes away. Yes, in the short term, there'll be some capital fluctuations, but your coupon will stay pretty consistent. So you can see you can almost double your yield by accepting some capital risk. Now that very much depends on your ability to accept that additional risk. And that's something that you'll need to talk to your financial advisor about, or your trustees about. But if you require the additional yield, I'm sure people who are used to that 9% income are now struggling with a 4% income, you probably need to talk to someone about shifting a portion of your income and money market into enhanced bonds or passive bonds if you prefer it. We're not big believers in active bonds. You're getting the same credit pickup as enhanced bonds, but very few managers have proven that they can call duration basically playing the yield curve successfully, because that very much depends on interest rate hikes or cuts, and that's difficult to predict. But certainly the yield curve now, it's looking more attractive to sit at the long end than it was a year ago. And again, I think next Friday, so in a week's time, we're going to be having a bond webinar that speaks specifically to our enhanced bond fund and our all bond fund. So if you want to know more about that portfolio, please tune in for that in a week's time. Very interesting. I think it's well worth people considering whether if they are able to take on a bit more risk, or if they do need to increase the yield slightly, moving their assets from the one end of the yield curve to the other end of the yield curve, assuming you can take on that risk. So from a TAA perspective, that's our biggest call. We're much more comfortable holding, particularly in our balanced funds, where the low correlation absorbs that volatility quite nicely. If you're holding equities and dollars and other asset classes, that the volatility from bonds gets absorbed quite nicely. In fact, it balances that pretty nicely. On a standalone basis, it's a bit more tricky, but if you are going to end up with a 10% yield, you can stomach that additional volatility to some extent. Okay, so that's where we are. Let me look at our questions. Okay, there's a few political comments on Trump and some on Biden. Everyone's saying that I'm giving Trump a hard time. Okay, I'm also giving Johnson a hard time. So I apologize for giving our politicians a hard time. They are certainly creating volatility, which does give opportunities for us when we're well placed. Maybe I should thank them. Some questions on the medium-term budget policy statement in October. So at the medium-term policy statement, they generally don't discuss tax. They discuss, it's just an update of where we are. It gives an indication of changes to revenue and expenses. It's highly unlikely that there will be any new information on tax. That will wait until the February budget statement. And there we probably will see taxes being raised, just like they are being raised around the world, to try and cover that hole that has arisen as a result of COVID-19, where economies, again, around the world are seeing less tax revenue this year because of lockdowns, increased expenditure because of furloughs or additional allocations to healthcare. And so you've got this widening gap with expenses going up more than expected, revenue falling more than expected, and as a result, we'll have to see hopefully some expense cuts, but I'm sure there will be tax increases. Even if it's last that was discussed was a short-term, maybe 1 or 2 year tax hike from a solidarity perspective to try and fund the various healthcare initiatives that have happened during COVID-19. More questions again on the medium-term budget policy statement. It is the biggest risk facing the local markets. So I completely agree. So what Tito has acknowledged is that we face an important fork in the road. If we stick to what's currently happening on what he's called a passive scenario, our debt levels are going to accelerate, and we're going to end up not being able to even afford the interest cost of the debt. On the other hand, there's the active scenario, which he has chosen, and that leads to consolidation of debt by 2023, 2024, and that requires cutting expenses. So I think he's penciled in a 230 billion rand cut to expenses over the next 3 years to achieve that debt consolidation. That all happens next year and the following year. So I'm pretty sure he's not going to change that outlook. He's going to assume that some level of reforms happen. He's going to assume that those cuts can happen. So I don't think there's going to be anything negative in terms of the outlook. The outlook of the medium term is going to still assume debt consolidation. It's still going to assume that our debt levels peak and come down, that bond issuance comes down, which is all very positive for our bond market. It's positive for our currency market. However, it's based on promises. And markets are going to continue to doubt whether those promises can be delivered. In the short term, he can only discuss the last 6 months. So it's whether revenue is behind or ahead, whether expenses are behind or ahead, whether bond issuance are behind or ahead. Now, we know bond issuances are ahead, so that's a positive. We think revenue is actually in line because although the economy has fallen, it hasn't fallen as much as expected. And expenses, well, it very much depends on the outcome of the labor dispute that has gone to court. But the longer they delay that, the more likely is the government that's going to win. So of the 3 updates that we can happen, they definitely are more neutral to positive. And I'm expecting a positive, net positive impact in October. Of course, it comes down to investment confidence. Will whatever happens in October be enough to change investment confidence? And that's unlikely. That requires reforms, that requires a crackdown on corruption. Those things are starting to trickle in, but they haven't happened in any meaningful way. And so it's likely that the market's going to buy its time and wait to see what happens over the next while, and whether we get or maintain that active road. February will be the next big key event where we see what happens to taxes, what happens to expenses, are more reforms happening. So at the moment, as that IRR sheet showed, reforms going backwards, not forwards. So that's the most important thing to watch. Investor confidence is going to be based on the reforms. The reforms are what is going to allow the active scenario to happen, and we'll have to see. However, as negative as I'm sounding, and as negative as the global institutions are on South Africa, things are actually happening behind the scenes. So what we need is a strong social compact between government, labor, and business. For the first time in history, there is an incredibly strong convergence between what labor want and what business want. Listening to COSATU, labor and business are pretty much 95% aligned on what we want. We all want corruption gone. We want Eskom fixed. We want job creation. We want the economy to grow. So with that strong convergence of views, there's a very, very high probability that government has to listen. Cyril has faced a divided cabinet for the last while. Reforms haven't happened as fast as we wanted them to happen, and it's been a difficult place it's been difficult for him. But we're starting to see that accelerate, and I think he has to buckle. That whether it's a cabinet reshuffle or just more trickling of crackdown on corruption, the strong convergence between labor and business has to pressurize government and Cyril to listen. to accelerate those reforms and to fix tourism, to fix ESCOM, to get that telecom licenses out. Easy wins that need to happen have to happen. So I do believe that, and I am quite positive. I mean, I'm not ready to put money there yet. I mean, still underweight SA equities. The catalysts aren't clear, but behind the scenes, there's very, very strong movement between business and labor. The social compact, while not evident yet, is being worked upon, and I think that we will see an acceleration in reforms on the positive side, that there will be an acceleration on the crackdown on corruption, and I think we could see some very positive news come through over the next 6 months, which will lead to investor confidence improving. And that goes hand in hand with the infrastructure program. There's a question on the infrastructure program. It's a bit of a chicken and egg scenario. So infrastructure program needs lower bond yields to make it more attractive to private sector investment and to make the infrastructure programs more affordable. At the same time, infrastructure program will drive growth, it'll drive tax revenue, and it'll drive job creation, which in itself will allow lower bond issuance and lower yields and a flatter yield curve. So, you know, the one's waiting for the other, and the other one's waiting for the other, but hopefully they'll both start to move along. ESG stands for environmental, social, and governance. It's 3 pillars in terms of making investments sustainable, basically. It's all about making investments sustainable, whether it's bonds, money market, equities, local or global. You do it from an environmental aspect, green. You do it through a social aspect in terms of making sure that what's happening is good for communities. And you do it from a governance perspective to ensure that companies, business, is being ethical and looking after all stakeholders, not just shareholders and employees and clients, but the environment as a whole. It's vital for long-term returns and even medium-term returns, and that's why Sygnia has incorporated it across all our spheres, passive and active. A question on the satellites. So on the tech side, it's FANG, although we are underweight that, and 4IR. On the healthcare side, it's our Health Innovation Fund and OSI. On the credit side, it's our enhanced income and mostly, but a little bit enhanced bond. On the property side, it's our Sygnia property ETF. And on the emerging market side, it's Asia mostly, but it's emerging markets Asia. And we currently are just using an iShare ETF. We will be launching our own emerging market 50 ETF within the next 2 months. So please look out for that additional ETF coming soon. We're also going to be launching a suite of ESG ETFs to assist on the passive side. Those should also be out within the next 2 months. FANG stocks, as I said, structurally, we still like them. Right now, we prefer 4IR, but tech is a disruptor. The FANG stocks are going to be with us for a long time. Medium term and long term, we do like them. We believe they should have a structural weight in a portfolio. We're just underweight the structural weight in the short term. Inflation, right now, I can't see inflation rearing its head anytime soon. There's just too much uncertainty. There's not enough investor confidence. There's not enough pass-through inflation. Until growth recovers, we're going to see inflation just like it has. We stick to the Japanification roadmap. We'll exit deflation or disinflation before Europe and the US, but it's going to be a year or two before we see some sort of inflation come through. A question about offshore funds. We have just launched the Sygnia Skeleton Global Balanced Put Range, which is 100% offshore for living annuities. So if you are looking for that, please have a look on our website. Bitcoin, don't understand it, won't touch it. Same as gold. All our balanced funds have allocations to the satellites. So it's the signature range and the skeleton balanced range. All balanced ranges have exposure to all 5 satellites. And then our global range has exposure to the 4 global satellites. A quick question on the US. We are underweight the US, still the biggest exposure in our fund. We've got a small underweight position because we think the dollar will weaken and because we're worried about the big exposure to those tech stocks. But the US is our strongest and biggest exposure in the long term. So again, it's breaking down structural to tactical views. And unfortunately, we're out of time and we're out of questions. So thank you very much for tuning in this month and have a great October.